In the last 48 hours, silver has behaved like a market that's running out of room to breathe. Not months, not weeks, in 48 hours. 2% to 9%. That sounds small until you remember what margin really is. It's the gate. It decides who gets to stay in the trade and who gets pushed out. And here's the part that breaks normal expectations. At the same time that holding paper exposure is becoming more expensive, the biggest derivatives venue in North America is moving to make silver easier to access. On January 13, 2026, CME publicly described plans to introduce a new 100-ounce silver futures contract, targeting a February 9, 2026 launch, pending regulatory review. The message on the surface is simple: smaller size, broader participation. But markets don't care about surface messages. Markets care about what timing reveals. Most people experience silver as a chart, a line that rises and falls. Institutions experience silver as plumbing: contract sizes, deliverable inventories, margin policies, settlement mechanics, and regional premiums that whisper when metal is moving. If you only look at the line, you miss the system beneath it. And right now, the system is flashing a contradiction that doesn't last forever. What I'm about to lay out isn't a prediction, and it isn't a promise. It's a pattern, built from numbers that exist whether anyone talks about them or not. Once you see the pattern, you interpret headlines differently because the headline becomes an echo, not the first signal. Welcome to Vault Signal, where we decode what matters before it becomes the story everyone repeats. If you appreciate calm, data-first analysis, stay close, the way you'd listen to the one person in the room who speaks quietly because they've already done the math. And tell me where you're watching from, because markets are global, but the pressure shows up differently depending on where you stand. Now, let's get forensic about what actually happened. Start with the benchmark arena most people associate with the price: COMEX silver futures, under CME's umbrella. 44 is not just a number, it's a stress test. At levels like that, the futures market becomes a high-tension bridge between paper claims and the real world of bars in vaults. When that bridge is calm, spreads stay narrow and liquidity feels effortless. When that bridge is strained, the first signal is often not the headline price. The first signal is the terms of participation. Margins matter because they create forced behavior. If margin rises, the same position requires more capital. That doesn't just inconvenience traders, it changes market structure. It forces some participants to reduce exposure, not because their view changed, but because the rules changed. 2% to 9% can land like a shock, even if the percentage looks modest. The market is leveraged by design. A small margin adjustment can trigger a large repositioning, and large repositioning can move price even when nothing fundamental changed. Now layer in the contract announcement. A 100-ounce contract is smaller than the standard 5,000-ounce silver futures contract most people reference. Smaller contracts broaden access. They also create more granularity for hedging and for speculative participation. But there's a second effect that matters in stressed markets. Smaller contracts can increase the number of separate positions, which changes how quickly sentiment can express itself. When volatility rises, more doors into the market can mean more volume, but it can also mean more reactive flows, because smaller accounts tend to respond faster to margin, headlines, and volatility spikes. And while all of that is happening in the paper arena, the physical world is giving a different signal. On February 4th, 2026, a read of Shanghai versus the global benchmark pointed to a premium, roughly $93 an ounce in Shanghai versus roughly $90 around COMEX. Call it about a 4% difference. In a world where information travels instantly and arbitrage is supposed to keep markets aligned, persistent premiums are rarely noise. They are usually a symptom. They suggest that locally, people are willing to pay more to secure metal, because delivery, availability, or immediacy is valued more than a paper reference. This is where it gets interesting, because the market is telling two stories at once. The official story is that price discovery is centralized and efficient. The data story is that regions are bidding differently for the same metal. And that creates a question you can't ignore. If the price is the price, why does the premium exist? To answer that, you have to pull back and look at the historical playbook, because silver has always been the metal where structure matters as much as sentiment. In 1980, the silver market became a case study in how quickly rules can change when prices accelerate. It wasn't only price, it was the response. Trading restrictions, changes in margin, and an environment where the ability to hold a position became as important as the desire to hold it. The result was not a smooth resolution. It was a violent repricing driven by forced dynamics and shifting rules. In 2011, the pattern resurfaced in a modern form. Silver surged, and then a sequence of margin increases, and tightened conditions contributed to rapid deleveraging. The lesson wasn't that silver can't rise. The lesson was that when silver moves, the market's referees adjust the playing field, and participants who are overextended discover that their risk wasn't just price risk. It was rule risk, liquidity risk, and timing risk. In 2020 and 2021, a different version played out with retail attention, social momentum, and renewed focus on the gap between paper representations and physical availability. Even when the narrative got noisy, the mechanism underneath stayed consistent. If demand pressures the physical chain, the response shows up in premiums, inventory language, and the terms of participation. Now here we are in 2026, and the same outline is visible again, but in subtler signals. 44, 2% to 9%. You have CME announcing a smaller, more accessible contract with a target launch date of February 9th, 2026, pending regulatory review. And you have a regional premium around a 4% difference between Shanghai and COMEX on February 4th, 2026. When those pieces show up together, it's rarely random. It's usually the market preparing for a contest between claims and constraints. So who are the players, and what are they doing? First, there's CME Group, the exchange operator, setting contract specifications and margin frameworks. Their move toward a 100-ounce contract is framed as meeting demand, particularly from retail participation. But anytime a new contract is introduced, it's also an admission that the existing structure doesn't fully serve current flows. A smaller contract helps price exposure fit different account sizes, but it also changes how pressure is distributed across the system, because participation becomes more granular and more widespread. Then there's the regulatory layer that sits above the exchange. Futures contracts don't exist in a vacuum. They sit under oversight that cares about orderly markets, clearing stability, and systemic risk. That's why the phrase pending regulatory review matters. It tells you the exchange expects enough interest and enough sensitivity that the product launch is part of a supervised ecosystem, not just a product release. In practice, that oversight focuses on how the contract settles, how it can be delivered, and whether the design encourages stability or fragility under stress. Next, there's the clearinghouse logic behind margins. Margin is a reflection of volatility, liquidity, and the clearing system's need to guarantee settlement. When margins rise, the system is trying to keep the bridge from shaking too hard. It's the market saying, volatility is high enough that the house wants more collateral before it allows the same exposure. Then there's the physical reference infrastructure. The London Bullion Market Association publishes monthly vault data that gives a snapshot of metal sitting in reporting vaults. End of January 2026, data placed silver holdings at 27,729 tons, valued around $92 billion, representing approximately 924,304 silver bars. Those are huge numbers, and they can create the comforting feeling that there is plenty of metal. But a headline total is not the same as available float. Some metal is tied up in long-term holdings, some is pledged, some is sitting in a form or location that is not practical for immediate mobilization. Then there are the ETFs that act as a bridge for investor exposure. One of the most watched is iShares Silver Trust, often cited around 15,736 metric tons, or about 502,763 ounces. Whether someone loves or hates ETFs, they matter because they concentrate flows. When inflows occur, metal must be sourced, and that sourcing can tighten the chain. And when outflows occur, metal can be released, but only if it moves through real-world channels and only if it's in the right form and location. ETF creation and redemption is a way that paper demand can reach into physical supply, and that linkage becomes more important when regional premiums appear. Finally, there's the east-west axis. Shanghai is not just another price screen. It is a window into a region where physical demand can be more directly expressed, where premiums can reflect local constraints, and where the willingness to pay above a global reference can reveal what the paper benchmark is missing. Now connect those players through timing. A contract announcement on January 13th, 2026. A targeted launch on February 9th, 2026. A premium signal in early February, with Shanghai around $93, while COMEX reads around $90 on February 4th, 2026. A margin environment where holding exposure is more expensive. This is coordination in the practical sense, not the sensational sense. Markets coordinate through incentives and risk management. When volatility rises, institutions don't need secret meetings to move together. They simply respond to the same constraints, and that response looks like alignment. This is the part many people miss. The market can appear liquid right up until the moment it isn't, because most of the stress is absorbed by mechanics that don't show up on a daily price chart. So let's talk about the dislocation directly. There are two silver markets, even though people like to pretend there's one. There's the paper market, where exposure can be created and traded rapidly, and there's the physical market, where bars must exist, be assayed, be stored, be moved, and be delivered. The paper market is efficient at expressing sentiment. The physical market is honest about constraints. When those two worlds align, you see it in narrow spreads, stable premiums, and a sense that everything is balanced. When they diverge, you see it in persistent premiums, sudden changes in the cost of participation, and heightened attention to inventories and delivery terms. The Shanghai premium relative to COMEX is divergence made visible. If Shanghai is willing to pay about 4% more, that difference is a price tag on immediacy. It can mean that local buyers value getting metal now more than they value an abstract global screen price. It can also reflect frictions, delivery timelines, local demand surges, refinery throughput, imports, constraints, and the reality that not all metal is equally accessible across borders on short notice. Meanwhile, the futures price can sometimes mask stress, because futures markets can absorb demand through the creation of contracts and the netting of positions. That's why the chart can look orderly even when the physical world is tightening. The gap can persist longer than people expect, but it cannot persist indefinitely without something adjusting, because at some point the system has to reconcile paper claims with real bars and real logistics. Here's the mechanism that turns this from an observation into an event. When margins rise, leveraged players are forced to adjust. Some reduce positions, some roll exposure differently, some step away. That can create downward pressure in paper pricing even if physical demand remains strong. At the same time, physical buyers may continue paying premiums because their objective is not to trade the line on a screen. Their objective is to secure metal for manufacturing, reserves, inventory, or long horizon allocation. That creates the appearance of contradiction. Paper says one thing, physical says another. And that window headlines can become confusing. Commentators argue. Some say the market is fine because the chart isn't exploding. Others say the market is broken because premiums persist. The truth is usually simpler. The market is transitioning from a phase where price sets the narrative to a phase where availability sets the narrative. To make this intuitive, think of the futures market like a stadium where tickets can be resold thousands of times before the event. Prices can move based on expectations and emotion. But the physical market is the venue itself. There are only so many seats. If too many people show up with tickets that assume a seat exists, the venue becomes the final arbiter. You can trade tickets all day, but the door only opens for the number of seats that actually exist. Silver is unusual because it sits at the intersection of monetary demand and industrial demand. It's not just a store of value story. It's also a consumption story. That means when stress hits, it doesn't just come from investors. It can come from supply chain needs. And when it comes from supply chain needs, premiums can persist even when paper markets are being forced to deleverage. This is why dislocations show up first in the small details. Nearby futures, months, can become unusually sensitive. The cost of financing and carrying can shift. The willingness to pay for immediate delivery can rise. The gap between a standardized benchmark and a regional physical reality can widen. None of this requires drama. It only requires pressure, and pressure is exactly what the numbers are hinting at. One more detail ties the paper world to the vault world, the categories of metal and the promises written against them. In futures language, not every ounce sitting in a vault is ready to satisfy delivery. Some metal is eligible, meaning it meets specifications, but it is not committed to the delivery system. Some is registered, meaning it is specifically available for delivery against futures. That distinction can matter more than the headline total, because a large vault number can coexist with tight availability if most metal is simply not offered. When tightness rises, you often see it in the cost of immediacy, in the way nearby pricing behaves, and in the way participants prefer cash settlement or exchange for physical routes instead of straightforward delivery. Those choices are not drama, they are traffic patterns. And when those traffic patterns change quickly, it usually means the market is rationing metal through rules, not through headlines, in real time. Now, let's anchor this entire conversation in the specific figures that keep it honest. 44 per ounce on COMEX futures. That is a level that changes behavior because it affects how much capital is tied up, how much risk is perceived, and how quickly margin models react. 2% to 9%. Higher margin means higher carrying cost. Higher carrying cost forces weaker balance sheets to reduce exposure. Forced reduction can happen even when the underlying view hasn't changed. It's the market equivalent of the thermostat being turned down while people are still in the room. Third, the contract innovation. CME describing a 100-ounce silver futures contract, aiming for February 9th, 2026, pending regulatory review. In plain language, that means the exchange is responding to demand for smaller, more flexible exposure. In a calm market, that might be routine. In a stressed market, it is consequential because contract design shapes how demand expresses itself and how volatility spreads. Fourth, the physical snapshot. London Vault data showing 27,129 tons of silver at the end of January 2026, valued around $92 billion, representing roughly 304 bars. The number is real. The interpretation is the challenge. Total inventory is not the same as deliverable inventory, and deliverable is not the same as available at the benchmark price on short notice. Fifth, the ETF proxy. SLV often cited around 15,636 metric tons, or about 502,712,793 ounces. That scale matters because flows into or out of that structure can stress sourcing, influence lending and borrowing of metal, and change where tightness shows up. Sixth, the dislocation signal. On February 4th, 2026, Shanghai roughly $93 versus COMEX roughly $90, implying about a 4% premium. That premium is a footprint. It suggests something about local conditions that the global benchmark isn't fully reflecting. Taken together, those figures outline a system where paper access is being refined, paper participation is being made more expensive, and physical demand is expressing itself through premiums. So what does this mean going forward based on what the pattern has historically led to? Historically, when you see rising margins and persistent physical premiums, one of three broad paths tends to follow. In a conservative scenario, the system cools the market. Higher margins and risk controls reduce leverage, price consolidates, and premiums gradually compress as supply chains adjust. In that scenario, the story becomes quiet again, and the dislocation fades without drama. In a moderate scenario, the premium persists while paper markets oscillate. You get episodes where futures prices dip on forced selling, followed by rebounds as physical tightness reasserts itself. Volatility increases, narratives swing, and anyone who only watches the headline price experiences whiplash, because the real driver is the tug of war between forced paper positioning and persistent physical pull. In a more aggressive scenario, the dislocation forces a repricing in one arena to reconcile with the other. That can happen if physical tightness worsens, if demand surges, or if confidence and availability behind paper claims weakens. In that case, the market doesn't need one dramatic headline to move, it simply needs the friction to persist until the bridge resets into a new equilibrium. Notice what's missing from those scenarios. There's no certainty, there's no guarantee. There's only the historical observation that when mechanics tighten and premiums persist, the market is rarely in a stable resting state. So what should be watched? Not as a prediction, but as a dashboard. Watch for further changes in margin frameworks because they tell you how risk managers perceive volatility. Watch contract adoption after February 9th, 2026, because it tells you whether new demand is entering through smaller doors. Watch regional premiums, especially persistent gaps between East and West, because they reflect physical conditions that can't be explained away by commentary. Watch language around inventories and delivery, because that's where stress speaks before it shouts. And watch how quickly price reactions follow those mechanical shifts. Because when mechanics lead and price follows, the market is telling you where the real lever is. This is the divide, and it has nothing to do with intelligence. Some people experience markets as entertainment. They watch price ticks the way they watch sports scores. Others treat markets as systems, where the plumbing matters more than the noise. The difference isn't who is smarter. The difference is who is paying attention to the right variables. Institutions move first, and they often do it quietly because they are closer to the plumbing. They see margin models change before the public argues about the chart. They see contract design shifts before casual observers notice a new contract size. They see regional premiums in their order flow before it becomes a social narrative. And that's why moments like this matter. When the mechanics shift in plain sight, it's an invitation to stop watching only the line and start watching the structure. Silver doesn't need a conspiracy to become unstable. It only needs a mismatch between claims and constraints, and a set of rules that forces the weakest hands to exit at the worst moments. That is how every major silver episode has worked, in one form or another. So tonight, if silver's on your radar, don't just ask what the price did. Ask what the system did. Ask why holding exposure got more expensive. Ask why access is being broadened at the same time. Ask why a 4% regional premium can exist in a supposedly unified global market. Ask what it means that London reports 27,729 tons, and yet immediacy still commands a surcharge elsewhere. Ask why hundreds of millions of ounces can sit inside an ETF structure while the physical chain still signals stress at the edges. Because if you can see those questions clearly, you can see the narrative before it becomes headlines. This is Vault Signal, where we decode what matters before it's the story everyone repeats. If this connected dots you hadn't lined up before, you know what to do. And remember, the question isn't whether markets change. The question is whether you can recognize the moment the plumbing starts to groan.